Hi. Today we are going to discuss very important topic in admission of a partner. That is the treatment and adjustment of goodwill. First we can discuss what is the meaning of admission of a partner. Inclusion of a person or a new person into a partnership business is known as admission of a partner. That partner has two rights: right to share the assets of the business, right to share the liabilities and the profit of the business. One of the most important treatments in the admission of a partnership is treatment of goodwill. That is a little complicated one. So we can study what will be the treatment of goodwill in the admission of a partner. We know that a new partner is coming to the business. Whenever a new partner is coming to the business, the existing partners will lose some amount or some profit in the future. So to cover that, the new partner brings some compensation or some amount to cover that one. That amount we can call as premium for goodwill. This goodwill is clearly mentioned Accounting Standard 26. The Accounting Standard 26 says that when goodwill can be recorded in the books of account, money or money's worth we are paying, or the purchased goodwill is there, then only we can record in the books of account. Let us discuss what are the important treatment of goodwill in the admission of a partner. One by one we can discuss. First point is goodwill is paid privately. Second one is goodwill brought in cash or check by the new partner and it can be retained in the business. Third one is goodwill is brought in cash or check by the new partner and it is withdrawn by the sacrificing partners fully or partially. Next one is goodwill is brought in kind. That means no cash or check. Next one, when a part of goodwill is brought by the new partner, that is, only a part of the goodwill can be withdrawn by the partner. And when a new partner does not bring his share of goodwill in cash or in kind, then hidden or inferred goodwill is there. So these are the main treatment of goodwill in the admission of a partner. After this, we can discuss one by one adjustment, how it can be reflected in the books of account of the partnership firm. First point is goodwill is paid privately. Here, goodwill is paid by the new partner privately. So no need any amount shown in the books of account. That means there is no journal entry is required because it is paying privately by the new partner. Second one is goodwill is brought by the new partner in cash or check and it can be retained in the business. Here the goodwill is brought by the new partner in cash or bank. So the first entry will be cash or bank account debted to premium for goodwill. Please note that he will bring only his share of goodwill, not the total goodwill. So the new partner should bring his share of goodwill in cash or bank and it can be retained the business. Therefore, the first journal entry is cash or bank account debted to premium for goodwill. That means he bring goodwill. Second one is this goodwill is bringing for whom it is for the sacrificing partners. So the entry will be premium for goodwill account debtor to sacrificing partners capital. In this case, we have to pass two entries. One is for bringing goodwill, second one is sharing goodwill. Important point, another is here, this goodwill is the compensation given by the new partner to the sacrificing partners. So it can be divided only in sacrificing ratio. So instead of passing these two journal entries, we need to pass only one entry. Then only one entry is cash account debted to sacrificing partners capital account. That means here premium you can see one credit is there, here premium you can see one debit is there. Both of them will nullify So only one entry. Instead of passing this two entry, he can pass only one entry also. That also possible. The entry is cash account debted to sacrificing partner's capital account. The ratio always will be sacrificing ratio. This is the second point. Third one is goodwill is brought by the new partner in cash or check and can be withdrawn by the sacrificing partners fully or partially. In the third case, the second entry will come same as it is because the new partner bring his share of goodwill in cash or bank and retain the business, right? Now the goodwill you can say it is in the account of the old partners or the sacrificing partners account. So they can withdraw the amount fully or partially from their account. So opposite entry you have to pass sacrificing partners capital account debted to bank. While passing this entry, you should remember one point. You have to clearly check the question. Sometimes the question will say fully withdrawn by the sacrificing partners. If it is fully, just to pass the opposite entry. If it is partially or 50%, so you have to take only that part only. So instead of passing these two entries, you can pass one entry, and the same model you can reverse entry for the withdrawal also you can do. The third case, goodwill brought by the new partner in cash or check and it can be withdrawn fully or partially. That is based on the question. The ratio always is sacrificing ratio. Adjustment number 4. Goodwill is brought in kind. That means the new partner is unable to bring his share of goodwill in cash. In such a case, the goodwill can be brought by the new partner in kind. Here kind means he can bring any asset for the equal amount of the goodwill. In such a case, any asset, for example, land, building, plant, machinery, anything they can bring as an asset. In such a case, the journal entry or the accounting treatment is asset account debted to sacrificing partner's capital account. Here, the new partner does not bring in cash, he is bringing some asset to cover his share of goodwill. Next, when a part of the goodwill is brought by the new partner, sometimes the new partner can bring only a part or some portion only. So the remaining he cannot bring. In such a case, how much his portion bring as cash, he can write bank or cash account debtor. How much shortage is there? For example, 25,000 is his share of goodwill. He is bringing only 10,000 goodwill. The remaining we want to adjust 15,000. So the entry will be bank account debtor 10,000, incoming partners capital account 15,000 to sacrificing partners capital 25,000. So how much amount he is bringing, that amount he can debit here. How much amount he is not bringing, he cannot bringing, that his name will be debited here. That means this amount will be given by the new partner later only, or we can adjust from his account. So the accounting treatment will be bank account debtor, incoming partners capital account debit to sacrificing partners capital. All these ratios are sacrificing ratios. Then adjustment number 6. When a new partner does not bring his share of goodwill in cash or in kind, that means he is unable to bring his share of goodwill in cash or kind. In such circumstances, anyway, in the future, that amount should be compensated by the new partner. So instead of bringing in cash or kind, what we can do, we can debit his name. So that amount can be covered from his account. The entry is new partner's capital account debted to sacrificing partner's capital account. Next and last adjustment of the goodwill is hidden or inferred goodwill. Hidden or inferred goodwill means goodwill is not given in the question. That means we don't know the exact value of the goodwill. But the information given in the question, based on that, we can find out the value of goodwill. So hidden goodwill is one of the most important part of the admission of a partner. Through the example, we can understand hidden goodwill calculation. A, B, C are the three partners in a firm. Old partners are A and B. C is a new partner. He brings 60,000 as his capital. His share we agreed is 1/4. Therefore, the total capital of the firm will be 60,000 divided by 1 into 4 is equal to total 2,40,000. This 2,40,000 is the total capital of the firm, including A, B, and C, three partners. But when the total capital of three partners we are adding, it is coming 2,10,000 only based on the example. So we can understand that the remaining amount can be treated as goodwill. So the remaining amount here means the total firm's capital is 2,40,000. Three partners' capital together is 2,10,000. So the remaining 30,000 will be the amount of goodwill. This is known as hidden or inferred goodwill. Thank you.